tariffs, and markets are currently pricing in an 87% chance of a 25 basis point rate cut ahead of two key inflation prints that are coming out later this week. I want to bring in Jennifer Lee, a senior economist and managing director at BMO Capital Markets. And Jennifer, it's great to have you back here on Yahoo Finance. Let's talk about what exactly is at stake here with these two inflation prints. I guess how critical are they critical in how the Fed is thinking about how much progress we have seen in terms of the fight to tame inflation, what ultimately it will signal about the path forward?
So good morning, and thank you very much for having me on. You know, the data are always important, but I got to say these days it's almost like less important, especially on the inflation front. I mean, we know that, inflation has been coming down. We're no longer at, 9% or whatever it was a couple of years ago. And the Fed chair said a few weeks ago that, that he believes that inflation is heading sustainably back down to that 2% target. I think what's probably more interesting at this point is what's going to happen next year, and with the planned tariffs that are going to be kicking in. Who knows? Maybe on day one of the new presidency. So that I think is going to be more worrisome, I think, for the Federal Reserve. So, I think a 25 basis point cut in a couple of weeks is almost like baked in, unless it's something outrageously weird happening in the November CPI numbers and the PPI numbers. I think it's more it's more important to see what they're going to say, what the communication is going to be after they make their announcement at the next meeting.
So it sounds like you are not anticipating us getting any kind of whispers from the Fed through a Nick Timrose article at the Wall Street Journal heading into that December 18th meeting.
It seems like we always do somehow get a little bit of a whisper, but again, actually it'd be very interesting to see what he says. But assuming that, inflation is up modestly, on a month-to-month basis, we see roughly the year-over-year heading a little bit higher, still a bit too hot for the Fed's comfort. We might see some stickiness still in housing, in the services sector in particular. That's going to prompt, probably just again a 25 beat rate cut. But we are going to see what they say, what the communication is, what their forward guidance is going to be. And I think they're going to be highly, highly data dependent. And there's going to be a lot, that's going to be happening in the first couple of months of next year that will help determine which direction. Actually, we're assuming that they're going to continue cutting, just more like the cadence or the pace at which they're cutting will be determined, I think, with whatever happens in the new year.
Jennifer, what is your assessment just of where things stand? Obviously, we talk so much about inflation, but when you take a look at the jobs market, especially on the heels of the print that we got just last week, is there anything that is still concerning to you, or when you take a look at the print last week, aside from the unemployment rate ticking up just a bit, it really shows the fact that the labor market does remain resilient and on strong footing?
It is. I'm very interested in the wage front in particular. We saw it still decent, a little bit higher than expected, average hourly earnings pace. We saw that in the latest personal income and spending numbers, up about 0.4, 0.5%, which is what the average we've been seeing over the past year. And that's good news for consumers. It shows that, besides the fact that the labor market is still pretty healthy, we've got decent job growth, we've got decent wage growth, and that underpins a stronger consumer going forward. But of course, it all depends on how much prices are going to be rising, whether or not inflation is going to be really flaring higher or not in the coming year, and that will also help determine consumer spending. But as long as they have something put aside for a rainy day, as long as they tuck a little bit aside for their in their savings, I think the consumer will be well placed to deal with higher prices, or at least slightly higher prices.
Well, one reason they may be well placed is because we're continuing to see wages growing up. Morgan Stanley this morning noting that aggregate payroll incomes are rising at a 5.5% annual rate, and that's continued to accelerate every single month over the past few months. When does that wage growth start to stoke more demand and therefore reignite inflation?
So we could potentially see some pulling forward of spending. If consumers are, again, with some decent savings, behind them, if they are anticipating higher prices in the coming months, you could see some pickup in consumer spending, and that could flare potentially more inflation, and that would be something that will not be welcomed by the Fed. So this is something we would have to certainly keep an eye on. But I think it's not just like a spending on a month-to-month basis. Again, it's how much they're putting aside, which is, I think, more very important. Again, just to show that they are well placed to deal with anything that comes their way, or almost anything that comes their way. As long as there's some savings put aside, I think it leaves the consumer in good shape.
Building on the Trump policies and what we could see play out here over the next several months, next 4 years, how should investors just be thinking about that, just in terms of the economic side of things, what ultimately it's going to mean for economic growth?
I'm going to have to say to expect the unexpected. Uncertainty is going to be one of those certain things to play out, and you just have to be very cautious. And again, depending on how the tariffs play out, whether or not we are going to actually see, that 10, 20% blanket tariff on everything that's coming into the U.S. If it indeed will be 60 or 70% on imports coming from China, that could push prices higher. Of course, all of it will depend on what U.S. businesses are going to do with those higher prices. Are they going to eat it, or are they going to pass it along to the end consumer? And most likely they're going to, pass it along to their customers. And that will be playing out in the higher inflation front. So we have to be very cautious to see how that plays out. And of course, what retaliatory measures are coming back as well from the U.S., whether or not their trading partners will sort of take it, or they will say, we are going to tariff your things as well. So a lot of things, a lot of balls up in the air, and so much uncertainty. So I think you have to be very cautious heading into the new year.
All right, Jennifer Lee, thanks so much.